Let's talk about livestock and poultry outlook and get through this. We're running late here. First, let's talk about the demand side. Macroeconomic variables, a mixed bag. The latest labor reports last week were kind of soft. There are some numbers that were good, but the May employment number up only 38,000 jobs. That's not very good at all, especially compared to what we've been doing over the last 6 months or so. October through March averaged 239,000 more people at work each month during that time period. The labor force is record large, but the participation rate remains extremely low, close to record low at 62, 63%. One of these things, Millie, when I get some time, I'm going to call the BLS and ask them how they measure that, because I can't believe that 37% of the labor force can afford to not be participating in the labor market. So I have some measurement questions about that. At least I'd sure like to be able to be in that 37%, but Eric won't let me do that. So anyway, median real household income, though, is down 7.2% from its peak back in 98, 6.5% from 07. Let's interpret that. It means that over the last 20 years, almost 20 years, on real dollars, the average household in the United States has 7.2% less money than it did 20 years ago. And we wonder why there's a little bit of anger showing up in the political races. I think, there's some issues here. By the way, unemployment rate at 4.7%, that's a very low number. In fact, it's a number that I would argue is probably below the natural rate of unemployment. Longer term, we'll probably see some wage pressure on that and some inflationary pressure if we keep unemployment rate that low. Real personal disposable income, a really important variable in my mind on the demand side, still growing very nicely at about an average so far of 2.5% this year. It averaged a little over 2.6% last year. We strung a couple of good years together here after two very soft years in 2013 and 14. One of the concerns I have on the demand side is when we look at these measures of consumer attitudes, and there are two that I follow. I think they're the two that kind of everyone follows. The University of Michigan does a consumer sentiment survey. The Conference Board does a consumer confidence index. That's the red and blue lines here. And as you can see here, since 2015, these things have been flat. They have not been going up. Millie and I were in a meeting last night that somebody argued that consumer sentiment was just getting better and better. And I was sitting here biting my tongue, Millie, and I thought, I'm not going to pick a fight here. But you witnessed it, Millie. For once, I didn't pick a fight, okay? All right. So, but this consumer sentiment thing has kind of leveled off. It had been recovering very nicely from and it has recovered very nicely from the recession, but it's not getting better like it was for some time. I just put the inflation rate as the green bars in the background. Interesting, clear negative correlation between consumer attitudes and the unemployment rate. I said the inflation rate. It's the unemployment rate. So let's look at measures of demand. Real per capita expenditures. We've been on a very nice uptrend here since the end of the recession. In 2011 or so, we had a peak back in 2004 for meat demand, and that was driven by the Atkins diet. This last one has been a real change in a number of things. Number one, the recession. Number two, changing attitudes toward animal fats, cholesterol, those kinds of things. We realize that they're not the demon that they once were painted to be, and so we see this increase in demand that has been going on. Now, it's softened a bit this year relative to a year ago, not so much because things are bad this year, but because we're comparing to some really big numbers 1 year ago, and you have to be careful of that. Notice that the last observation on this chart over on the right, April would be the last observation. This normally bottoms out in March or April of the year, and the bottom for this year is well above the bottom for 2 years ago. It looks to me like we still have a very strong uptrend going. I'm not terribly concerned about this. When we look at individual species, beef in the upper left, chicken in the bottom, pork is in the upper right here, and we can see that all of them were down basically until April, and pork showed a 3% increase year over year. Now, one of the challenges here, especially on the pork numbers, is that that's a number driven by per capita consumption. And 1 year ago, the situation on our ports, our West Coast ports, was backing product up that actually showed up as being consumed in the United States until it was finally shipped out in April. So it's been an apples and oranges comparison so far this year. I'm kind of looking forward to May on because I don't think we've got any distortions in the data that's going to cause goofy things. And April was generally pretty clean. And again, pork demand higher than a year ago. If we look on a long-term basis, this is real per capita expenditures for pork, and you can see that we pushed those numbers back up to the levels that they haven't been at since the early 1990s in the last couple of years. And again, the low for this year is higher than the low for last year, and it looks to me like we're going to be on this uptrend. I expect that the high for this year, which usually comes in the fall for real per capita expenditures, will be higher than last year's high. Look at pork's share of total three species real per capita expenditures. This is a key metric of success or to measure the effectiveness of checkoff programs. We were down a bit in January and March, up 4% from a year ago in April. So far this year, pork has claimed about 25.7% of real per capita expenditures for the three major species. That number should be 25.8% last year. I forgot to change my typo, John. So just down 0.1%, very small. I think we're going to gain some on this as we go through the summer months, and so we hope that's the case because it is one of the key metrics that the pork checkoff is trying to improve is pork's share of total meat demand as we go forward. Total meat per capita availability going to be up slightly this year. The big increase in the amount of meat available in the United States was last year. 5% growth up to about 205 pounds. That's not anywhere near where we were at the peak of 220 pounds back in 2007. We don't foresee us getting back to that level at any time soon, and probably not at all. 210 pounds might catch this thing, but still modest increases in per capita availability the next 2 years, especially relative to the big jump that we saw in 2015. If we look at retail prices, this is the real evidence of strong demand and, of course, much higher retail prices. You know, you can increase demand by selling more product, but you can also increase demand when you sell the same amount of product for a higher price. And that's certainly what we've seen over the last couple of years. Retail pork prices normally bottom out in late spring. They normally rise seasonally as they go into the fall. We think that these prices on retail pork, the pink line here, will go back up to near $4 a pound this fall, but still moderating from their peak of 2014. If we look at the relationship between beef price to pork, that's the blue line at the top, and chicken pork is the pink line at the bottom, you can see that pork is still a real great value relative to beef. Normally, pork is priced at about 140% of the price of beef on average in the retail case. Right now, beef is priced at 170, 180% of the price of pork, and so we still have some real advantage there for this year. Okay, I'm going to talk to you about broiler outlook. This work is done by Sue Trudell on our staff in Fort Wayne. She provided these slides, and so let's talk about where we think the chicken situation is going to go. The supply flock up about 2% last year. The growth of that supply flock is going to slow over the next 2 years to less than 1% in each of those years. Not nearly the kind of rebound that we saw in 2015 on the number of hens out there producing eggs for the broiler supply. In addition, this very steady, dramatic increase in weights over time, which is really driven by a shift from small bird production to large bird production in big parts of the broiler industry, is going to slow pretty dramatically. We've run into some quality problems called, it's a texture problem in the muscle of breast meat called woody breast that has really been evident in the fast-growing large birds. They're slowing those birds down. They're going to not grow them nearly as add more weight to them, at least until they solve this problem. It's kind of genetically related because it's mainly in one genetic line. Eric, correct me if I'm wrong. It's in both of them, but they think genetics is an important part of it, and growth rate's a big piece of it. So because of that, we're not going to be switching to those heavy birds and pushing those heavy birds, which are all processed, boned out for breast meat, for boneless breast meat. We're We're not going to do that at nearly the kind of pace we have in the past, and so we see weights going up at a much lower pace this next year than what we've seen in past years. Okay, broiler retail ready-to-cook production. Again, the big jump was last year, up about 2.6%, slowing, the growth slowing to 1.1%, and then only 0.6% in 2017. So the broiler industry is growing, but it's growing at a slower pace as we go forward in time here, which means that they're not going to be increasing their supply nearly as quickly. Now, one of the issues that caused per capita availability of all the species to jump 5% last year was the fact that we were producing through about 3.5% more broiler meat, and our exports got hit by the avian influenza problems and dropped about 10% last year. Those are going to recover to some degree this year, but we don't see them getting back to 2014 levels before 2018 or beyond. You can see the growth that we have in our forecast right here. And so what does that mean for per capita availability? It means not much growth. We're going to be exporting more of that slower growth of output that we've seen over the next 2 years. So not a lot of growth in per capita availability on broilers through the 2016, 17, and 18. Pretty steady prices for chicken during that time period. If you're going to put the same amount of product on the market, you're going to expect prices to be relatively steady. This gives the price of regular sized and jumbo wogs or without giblet whole birds. And you can see that those are relatively steady through to the end of 2016 and 17. Some recovery of breast meat prices this year and some growth in 2017 because we aren't increasing the supply of that boneless breast meat like we were, since we're not pushing these heavy birds to heavier and heavier weights. And then, of course, on the leg quarter side is just a pretty dismal outlook that's there because of the problems we've had with exports. Leg quarters staying down in the 20 to 25 cent range, depending on the size of them. So the good part of this for pork producers is that we're not seeing dramatic increases in chicken production, which means that chicken prices are going to stay relatively stable. They're not going to gain a competitive position on pork, and actually will leave us some space in that retail case. Turkey outlook, of course, turkey last year took a big hit from HPAI. We saw calculated returns for turkey production just explode. It's, when you take out a decent amount of the supply, and inelastic demand means that price goes up more than supply goes down, and guess what happens to prices? It's the same thing we saw with PEDV in 2013 and 14 happened to the turkey business. Unless you lost the birds last year, if you were lucky enough to not be hit by HPAI, you made lots of money in the turkey business, and that's what this index says. We saw quarterly turkey pulp placements last year fall dramatically during the summer. Those are going to rebound this year back to more like normal kinds of levels, up 7% for the third quarter as we get prepared for the Thanksgiving holiday. When we look at ready-to-cook production on turkey, up 4% in 16, another 3.5% next year. But notice that that's still well below the record production that happened back before costs ran up with the ethanol program back in 2006 and 7. Still back to kind of normal on the turkey supply situation. One thing that has not recovered is turkey exports. The red line is last year. The brown line to the left is through March exports of turkey this year. You can see they're nowhere near where they were before. So some recovery of those exports would tighten this turkey supply. That has some real impact when we look at the price, especially. This is whole turkeys, and you can see some decline of those prices over the next 2 years as supplies go up. But look at what breast meat prices are forecast to do. Of course, they exploded last year on the shortness because of HPAI, but they're much more competitive this year. So if they could rebound some of their exports, we could see a little more strength in these prices. That's important, especially in delis, and could have some real impact on hams in that situation. Okay, beef and pork. Elwin showed you this drought monitor map a while ago, and I'll offer it with a little bit of different tack on it, and that is, think about all of the cows that are in the western part of the United States, basically from Kansas, Nebraska, South Dakota, North Dakota, Texas, and west, and look at the situation with drought in those areas. The only places we have any problem are California and the far southwest. We know there are some beef cows there, and that situation continues to get better. But where the main portion of the cows are, and Texas, Oklahoma, Missouri are the three top beef cow states in the United States, very little drought condition right now. What does that mean for pasture conditions? Going into this summer, I've never seen pasture conditions nationally as good as they are right now. Record low, poor and very poor ratings. The pasture guys are kind of pessimists. They don't look at good and very good. They look at poor and very poor. But this is a remarkably low number, and it comes off of a remarkably low number last year when we had much better grass conditions. What does that mean? Well, it means that the opportunity to grow the cow herd is certainly there because you've got grass to offer them, and we've got the incentive to grow the cow herd from these record high cow-calf productions the last 2 years. Forecast to be less this next year, but still over $100 a head. You can see what those profits did for total cattle inventory. That's the fastest increase in total cattle inventory we've seen since the 1970s. So rapid response to profits and the availability of grass to grow the cow herd. We're back above 30 million. Now that's still down from the 33 million that we had back in the 1980s, early 1980s, but still some growth from where we bottomed out here at 29 million 2 years ago. And that was, of course, in response to the 2011 drought, which took out about 3 million cows in Texas and Oklahoma. January 1 feeder cattle supplies, finally larger. It takes a long time to turn the ship on supply for cattle, but we finally got a bigger calf crop by 2.5% last year. We think the calf crop's going to be up 3% plus this year given the growth of this cow herd, and so we think these feeder cattle supplies will expand further going forward. May's cattle on feed report indicates generally just higher supplies going forward. Placements in the upper left, and I'm too far away to read my notes up there that I made, up 7.5% from a year ago. Cattle on feed marketings, though, have been up 1.1% last month after being up 7.1% in April. One of the real problems we got into, and you notice these marketing numbers, the upper right chart, the blue line is at the bottom of the 5-year range for basically all year last year. We fed these cattle too long and weren't marketing them fast enough. The cattle on feed 120 days plus on the right, on the bottom right, you can see big numbers in the second half of the year, and that's one of the things that broke this cattle market hard. Was we had all these cattle that had been overfed, they were too big, they were too fat, and we had to get current. Notice what the red line has done the last couple of months. It's dropped below a year ago on these long-fed cattle. We're getting more current all the time, and cattle on feed numbers are growing slightly, but one of the reasons they're not growing faster with higher placements is we're getting the cattle sold on a much more timely basis. That's going to support the cattle market. Now, if we look at where fed slaughter is, steer and heifer slaughter up to about 3% year to date. Average carcass weights have dropped back down to year-ago levels. Now, that's the good news. The bad news is they were awfully big a year ago. And so they're still putting plenty of beef on the market, even though the year-on-year impact has been smaller so far this year. FI beef production, we expect this number to grow as we go into the second half of the year, up about 3.1 and 3.8% in the third and fourth quarters, with higher slaughter weights, higher slaughter and higher weights. So the beef summary, production up somewhere around 4% in 2016, roughly the same in 17. The choice cutout right now is about $220, and that would imply $138 fed cattle. Cash steers were $128 last week, so pretty good situation for packer margins. The cutout was supported by middle meats. We've had a big rally. Ribeyes will retest their March highs here soon. Strip loins have already retested their spring of 2015 highs, almost $9. The end meats, rounds and chucks, are mainly being supported by trimmings. We got 90% Kimling trim up at about $220 now. It's rallied a bit, but I don't think there's going to be a lot more strength in that because we're getting more cow numbers. The real thing on the trimmings is we're going to decrease imports of trimming products from Australia, especially, pretty dramatically this year. So one of the kind of counters to the growth of beef production is that we're going to export a little more and we're going to import quite a bit less, so the net impact there is going to be a little bit smaller. May placements, our expectations are going to be up 7 to 9% based on kind of anecdotal evidence we have, but marketings remain pretty brisk. We're keeping slaughter numbers up, so I think we're going to stay very current going forward. It still kind of surprises me that we are trading live cattle futures down well below 120. That's a big move down from where we are now on the cash at 138 to get to a live cattle futures in the teens. And we still think that that's an oversold situation probably, and we'll see some strength in live cattle futures as we go through the summer. Okay, hogs and pork. Cost of production. Somebody told me a while ago that my cost of production numbers are too low. I guess I'll go tell Lee Schultz that at Iowa State. I base all these off his parameters. They're based on a revision of the numbers a couple of years ago to try to reflect more the market, the real efficient operations that are out there. The older parameters that I've had for several years were normally $5 to $6 higher than the best operations, probably pretty indicative of average. This is more of an estimate for the best producers. They would say that recent costs have been in the low 60s, 62 to 65. The run-up in corn futures right now would suggest that those costs are going up to about 70. That's what the green line is based on. It's based on corn futures. So if, as Eric pointed out, this is a weather scare and we get rain in June and July and these corn and soybean meal futures come back down, we won't run those kind of average costs for the second half of 16 and into 17. But that's what the suggestion is right now, 66.56 for the year. This year, of course, that compares just about where we were a year ago on average, but still much lower than where we were back in 2013 and 14. If we look at what that means for profits, right now, given lean hog futures, about $8.60 or so for this year, pretty much a break-even year for 2017 based on current lean hog futures. That number has been, it has been as high as $9.50. It would be significantly higher than that if it wasn't for the higher costs in the second half of 17 being reflected by these corn and bean meal. Excuse me.
Is that for the entire year, or is that year to date?
No, that would be the average for 2016, given the futures, given the current futures markets. That's the average for the whole year. Yeah. The average so far this year would be lower than that, Shane. I don't think we'd be there yet because you wouldn't have those good summer months in there. If we look at exports, of course, there's a couple of stories here. Number one is we're not in the export growth phase that we were from 2000 up to 2011. Still relatively flat. The data for April came out on Monday. It was down 11% from a year ago. But I want to point out that we're comparing April this year to the spike high that appears, this thing ain't working, last April. And you can see that spike high. What drove that? Cleaning up the port situation on the West Coast where product had backed up. All that product got shipped out, or a lot of it got shipped out in April. And so it's kind of an unfair comparison to make this year to April a year ago. Again, it's one of those numbers that beginning in May, we'll kind of have apples and apples to compare here, but that one's a little bit odd. For the year, we're up 0.25%. The story in this data, though, on Monday was the increase of exports to China and Hong Kong, up 95% from a year ago. Now, that sounds really impressive, but I want to point out that the number a year ago was really bad, okay? It's still a good number. And notice that China and Hong Kong, which is the brown line with the dots, has moved back to this long-term trend. The question in the marketplace at the moment, to me, is this going to be back to the trend, or are we going to see one of these surges like we saw in 2008 with the Olympics, or in 2011 after China suffered some massive losses of baby pigs in 2010 to backfill their supplies of pork. They have very high prices there right now. The Chinese government is very sensitive to pork prices because it's a major driver of food inflation when this happens. So they very well could be in the market. We have more competition from the EU now than we had in 2008 and 2011. So that would kind of limit this to some degree, but we had a lot of talk during May of good sales to China, and so we'll have to see how this plays out, but that was the big news. Every other market except Canada was lower than a year ago, and that includes Japan, that includes Mexico in those data. So still some concern here about what's going on in the other markets, but China is certainly good. On the PEDV side, this is data from the University of Minnesota's Swine Health Monitoring Project, data from about 1,000 sow farms, 2.6 million sows in this sample. It's not random, but it's darn sure big. And so it really is pretty decent representative. And we had no sow farms break in the most recent week of data for May 27th. The exponential weighted moving average line of the that you see computed there, the blue line, dropped below what has been set as the epidemic threshold by the veterinarians here. So that speaks that we're not having any problems. And notice that the number of cases we had all of this winter lower than we did a year ago. We're making no adjustments to supplies based on PEDV for this year. PRRS was a little worse this year. Our judgment is that it certainly was worse in spots, but when you take it in total, not much worse than the last couple of years, and so we have made no adjustments there. Now, there have been some producers kind of take me to task on that and say, we're going to run into some places here where we've lost a lot of pigs. I'm going to go back to my history of watching this industry and tell you that it's very difficult to find a PRRS outbreak in the data 6 months later, because the guys that talk about how bad the PRRS were, they lost pigs this year, but the guys that lost them last year didn't lose them this year, and they get spread out over time and blended in with other supplies. I don't think we'll ever see it in the data, and so we're not making any adjustments. The March Hogs and Pigs report was slightly bullish. If you notice over here, a lot of the numbers a little bit lower than what was expected prior to the report. The right-hand column, some negative numbers in there. A few numbers of note, though. All hogs and pigs, record large for March 1, 67.6 million head. Kept for marketing, record large, 61.66 million head. The lightweight inventories were generally lower than what was expected. And so that would say that we would have some strength as we go into the summer markets. We think that that's probably an accurate number. If we look down at the farrowing intentions, there's some problems there. And the problems are not the farrowing intentions numbers. The problems are the percentage change numbers, because they're being compared to what we think was some probably incorrect revisions a year ago in the data. I'm kind of in a running battle with the NAS guys on this at the moment because of their revisions policy, which I think kind of doesn't really look at what's going on in the real world. In addition, the litter size at 10.3 was slightly larger than a year ago, but we think there's some problems there. First, the breeding herd was down, and we take some issue with that. The breeding herd in March 1 is not normally smaller than the breeding herd on December 1st. This is the first time since 2010 that that's happened, and at that time, that was at the end of this large, long reduction in the U.S. breeding herd in response to high corn prices. We don't think that that was probably accurate, because a lot of anecdotal evidence said that we're growing the breeding herd. In addition, if we look at the state data, this report said that the Iowa breeding herd went down 50,000 head from December 1 to March 1. It has some other reductions in states that we know that there's growth in the breeding herd, and we just don't know what operations were going out of business that would offset that. The Iowa one, we come up with a decent explanation for probably 50 to 60% of it. Christensen Farms sold a group of sows, somewhere 25 to 30,000 sows to Seaboard back in the spring. That transaction was consummated on March 1. It looks as though those got dropped off of the Christensen inventories reported to the report, and either did not get added onto the Seaboard inventories, or Seaboard didn't respond to the survey this quarter, which is very possible. Whatever, that explains for part of that, but it still explains for a little over half of it. So still some problems there. We think that the breeding herd was understated, and we've got 1% growth in the breeding herd from December to December right now. We're probably going to go back and revise that up. All the anecdotal evidence we're hearing is that 60,000 more sows is not going to catch it. It's going to be more like 100 to 150. Yes, sir.
Don't we have a fair amount of going in on dairy?
Sure, that's one of the concerns we had about those numbers. We've heard about sow units in Missouri too, and so what we can't come up with is we can't come up with producers that we know have exited the industry that would offset it in the way that USDA indicates here. We know there are sows going in. This would say somewhere else there were sows going out, and we just don't know about them. I mean, I talked to the sow brokers after this report came out and said, "Did you guys see any big chunks of sows going out?" No, there just wasn't hardly any. There were a few that were in repops of some sort, maybe for disease issues, but nothing to this magnitude. So we think the breeding herd is a problem. We think the farrowings were probably a problem, and one piece of evidence I offer is this. This is farrowings divided by the breeding herd each quarter. And notice that this number has actually been going down over the last 3 or 4 years. This is an efficiency measure that we were pretty proud of for a long time, and we ought to be proud of it, and we still ought to be proud of it. But we think that this is going down for a couple of reasons. One is early on, we started weaning pigs a little older, which would reduce the turns of the sow herd. But I think the impact here really is the move toward pen gestation in the industry. It's not that pen gestation is inefficient, but it is a real challenge in the first year or two that you do it. You have to learn new ways to manage, and usually it has some impacts on efficiencies. And we have a lot of farms, pretty good number of farms, that are in those first years of transition from gestation stalls to pens.
There's that many?
I think so. They're kind of always ongoing, and it's not a very big drop, though, Millie. You don't have to have very many farms in there, I think, to cause this much reduction. I do think that this will stop. I think it's going to go down a little bit and probably level out here. But notice the 3 observations that I have circled. Those look pretty good, but all of them are due to revisions of past year's data when USDA revised the farrowings to try to account for subsequent more pigs than what they thought were coming to slaughter. And I think those revisions have caused these numbers to be biased upward. Yeah, Millie.
What do you think of the explanation that producers aren't working their sows as hard because the litter rates are so high? What do you think of that?
The question was, what would we think of the explanation that producers aren't pushing sows as hard because the litter rate are so high?
Just letting the litter rates do the work. That's the prevailing hypothesis in Washington. I'm here to tell you.
I don't think they've talked to many producers. Because, I don't think producers say, oh, she had a big litter, so I'm not going to push her very hard to get her bred back. They're still going to push them to get them bred back just as quickly as they can. So I don't believe that would be the case. Okay? Now, inside the Beltway might not know all the things in the real world, John. I know that's a shock to you. John used to be inside the Beltway, but he escaped, so that's good. We're glad of that. If we put this another way, this is an annual sum, and it says how many total litters per breeding animal, a one-time herd. You can see that it's pretty smooth when you do it this way with the downturn. If we use this kind of downturn to predict this year at 1.94 litters per breeding animal, a 1% growth rate, we would have 11.7 million litters this year. Right now, USDA, out of the March report, implies 11.5 million litters. That's 200,000 more litters than what USDA, the numbers would imply in that report. So we think that supplies are going up because of that. Finally, if we look at the litter rate here, the pig saved per litter for the DSFEB quarter, 10.3, that's the largest drop from the September-November litter rate to the DSFEB litter rate in history, except for when we had PEDV. We don't see any explanation for that. A normal kind of pattern would be the green lines you see at the top. Right now, we're going to split the difference with them for our forecast and say we'll take half the difference and say that there might be something there, but I'm afraid that we could be more closer to that green number. Now, one thing I'll point out is this number will not get revised. They may change the farrowings to account for more pigs, but the litter rate will not get revised. They never change it. It's a computed number. I don't know why there's so much confidence in it. Live hog imports from Canada is the last one that we're accounting for. We started importing more feeder pigs from Canada in early 2015, even before MCOOL was repealed. And so we think that's going to grow pretty steadily. We've added about 500,000 to U.S. slaughter this year for higher imports of Canadian wean pigs. We had initially put in an increase in Canadian market hogs coming. I've backed that off because last year had a couple of kind of outliers, and so I think we're probably going to be very close on market hogs, but certainly more wean pigs coming from Canada over the next couple of years, especially with the repeal of MCOOL. So what does that put us? If we look at our forecast so far, we've been right on the money on slaughter. We were only 0.5% off since March 1st, and the blue line here would be slaughter this year. Our projection for 2017 is the green line, the top one. There are the two packing capacity situations, and you can see that capacity is going to be very tight this fall. Once the two new plants are on board next summer, we shouldn't have a problem in 2017 from a capacity standpoint, even though supplies will be larger. Frozen pork inventories back to very normal kind of levels the last 3 months. You can see last year was the highest for pork inventories of the last 5 years, virtually all year. We've kind of reconciled that and got it pulled back. Now, total meat and poultry stocks are still higher than a year ago, driven almost exclusively by extra chicken stocks that are being held. But the situation for pork has gotten quite a bit better over the last 3 months relative to what's normally there. We talked briefly about packing capacity. Here's the plants that are planned over the next 3 years. Notice that I've dropped the plant for Prestige down to the bottom there, and I don't list a town on it because we don't know where it's going to land at the moment. And also, I would suggest that the timing on that plant is probably very much up in the air. I'm not sure that they can move now and find a new place to put it and still get anything done by 2018. I've not heard Ron Prestige or anybody from that company comment on that, but I don't think it's going to happen by then. This fall, we have two small plants that are supposed to come on board. As we understand, the one in Windham, there's lots of activity. They're still planning on trying to kill some hogs in October, November. The Pleasant Hope, Missouri plant had initially said that they thought they could kill hogs in August, and I haven't heard anything different from that. They would add a bit of capacity this fall. Now, the problem is they add 6,500. We lost the Greenwood, South Carolina plant here recently. That was 3,000, so the net gain is only going to be 3,500 for this fall. Next summer is the big bunch, and that would be the Sioux City, Iowa Seaboard Triumph plant at 12,000 per day, the Coldwater, Michigan plant with Hatfield, and I think it's 8 large producers from the Eastern Corn Belt at 10,000 per day. So 1.4% gain this fall, another 4.8% by the fall of 17, and assuming those are single shifted and the Prestige plant can come on in 18, would be another 2.2% by the fall of 18. I think right now my bet would be that the Prestige plant will not be on by the summer of 18, and that the Sioux City plant will be working very aggressively to double shifting during that year, especially if the Prestige plant is delayed. Picture of this, you can see last fall we had a couple of weeks just barely above capacity, and we can do that on a short time period. This year we're going to be very tight on capacity, and then you're going to have the blue lines going up pretty substantially over the next couple of years. Our forecast for slaughter, we've got second quarter slaughter up 0.1% of 1%. We think we're going to come in pretty close to that. The third quarter up a short 1%, and then the fourth quarter we see some real growth in numbers, up 2.9% from 1 year ago. If we go into 2017, our first quarter slaughter up about 2.9%, and we have projections out through 17. Each quarter is up over 2.5%, except the third quarter. It's up only 1.2% because there's one less slaughter day in the third quarter of 2017 relative to 2016. Prices, we've been trying to chasing the prices from the bottom side. Our second quarter price, 72 to 74, is going to come out to be very close. The price for April and May came in at 70. I got to do the math. Right at $70. We think the June price, the May price, pardon me, for March and April, the May price is going to be high enough to pull that into our range. I've just revised our third and fourth quarter prices up by about $3. We were much more pessimistic, and we're still not nearly where the futures market is. I can't get cash hogs as high as where the futures market is now. It's the third time you've had a chance to sell hogs for the third and fourth quarter of this year at very, very good prices. I think you should do that if you hadn't already done it, and still, and it would make for a very profitable year this year with the futures market where it is this week. First quarter of next year, we've got hogs right around $60. The futures for that quarter right now, the February futures trading at 68 and change. Again, an opportunity to price those hogs. I would be pretty aggressive about that. If you want to wait and kind of let this thing run up and tell you it's making a top, I can understand that, but I wouldn't let this opportunity go without pricing a very high percentage of your hogs for the rest of this year and even the first quarter of 2017. On the price side for individual pieces, the cutout value we think is going to peak at about $90 this summer. That would put hogs in the low 80s, 80 to 83 probably for the high here in July and August. Pork belly primal has sold off pretty significantly during the month of May. It was very high relative, especially relative to a year ago. We think that'll have some seasonal strength. If we look at loins, that's been one of the real drivers of this increase in the cutout value recently. And again, it's good that it increased, but it started the increase at a very low level. And loins have been a challenge for us for some time and remain so, even though the price is traded up here back to around $100 here, and we think we're going to get there in June. If we look at hams, again, a bit of a rally in April and May. I think this is the one to watch as far as the Chinese buying goes. They could get into this ham market and really make some difference here as we go through the summer. Risks, a negative risk, a major export disruption, foot and mouth disease, something like that, always the number one thing. Low probability, massive impact, okay? So you'd have to think about that. Negative or positive, PEDV or HPAI could have been either way. I don't think either one of those are likely now. I think we're past the PEDV situation, and we think we're past the HPAI. I'm really pretty surprised we got through the spring without problems on that, but it certainly looks like we've done it, and so that risk is pretty well gone. A possible positive is if I have underestimated the impact of PERS and PEDV. If they were worse than what I have accounted for here, then we could see some positive impact on prices. I don't think we'll ever see the impacts of those on supplies this summer, but I think you have to recognize that as a risk. A negative would be slower demand growth. We certainly have slowed the growth rate here. Domestic, I think preferences are still strong. We could certainly use a little strength on wages and income so that we could drive a little more food service trade and some positives on demand. Exports, the big factor is China, Hong Kong. It's been a positive in recent weeks. And, of course, the U.S. dollar has lost about 6% of its value since January. So that's been a positive for exports as well. I do think that that weakness of the dollar will probably push the Federal Reserve to raise interest rates. They didn't do it in June, but I think they're probably going to do it in September. I think we'll see another increase in interest rates. They just have to get some leverage in case they need it for the economy at some time in the future. Negative, packing capacity crunch, we talked about that. Another negative, what if we fill all those plants up by 18? What that's going to do to pork prices just from a supply standpoint. We're going to have to walk a tightrope here between the positives of having plants running full and very efficient and the potential negative of having too much pork to sell at profitable prices. And that's going to be the challenge we really have to deal with.